All right. Can you guys hear me?
Yes, sir. Can you hear me?
Yeah. Okay. Well, here's the thing. We'll start this out. Hey, Jeff, if you could, turn your volume off for a couple minutes, and then I'm going to introduce you, and then you turn your volume back on, and I'm going to turn off. Okay?
Yes.
All right, cool. All right, so welcome everybody to the MrTopStep Stock Traders Almanac webinar. Now, this is really is going to be a special webinar. Jeff himself is a special person. His father's like the inventor of this. And what I want to remind everybody as we go into the webinar, you know, one of the things I constantly talk about is a trader's toolbox. And I believe I learned this from the Pitbull when I first started working with him, that he asked me if I followed any historical stats, and I didn't. At the time, I didn't. But over time, as the Pitbull showed me more and more, you know, statistical things, the best thing that I could find and the most reliable thing that I could find was Jeff Hirsch and his father, Yale Hirsch. And these just very, very great people. Jeff is always accessible. He's and furthermore, the work is great. And look, at the end of the day, what's going on in these markets is you have to use all the tools you can employ. And there's a long history of reliable winning statistics here that Jeff's going to go over. And then what we're going to do is we're going to flip it over to Wayne Whaley from Winter and Leicester. Now, Wayne, the long and short story of this is Wayne was a customer on the floor in the S&Ps. He used the desk right next to us. Poor them. I used to attack them like crazy. And our desk tried to get Wayne's business for a long time. So I believe Wayne's firm's been around since 1979. There's a lot of comparisons and some of the things that Wayne and Jeff are going to be talking about. But I want to let you guys know that Wayne actually he'll talk a little bit about his background and the research, but he's actually trading his stuff all day long. They have an investment firm that he does the research for, and they trade. And then we're going to move over to Bob Mitchell from the MrTopStep Trading Forum that's taught me a little bit about the Fed's balance sheet and how the Fed moves money in and out and how that affects the swings and the daily swings of the S&P. But Bob will get more into detail about it. Then I'll come back. I'm going to talk a little bit about some of the craziness that's been going on in 2018. A little bit of a preview of what I think is going to go forward. Marlon Cobb, our partner, will come in and talk a little bit about the MIM, and then we'll wind it up. We know that it's going to be a little bit longer than we expected, but we figured with the weather on the East Coast as such, a lot of people would be in, and this would be a good opportunity to kind of hit the ball hard and hit it running. And listen, I want to invite Jeff in. Jeff, thank you very much for coming in. Yes, Bubs, and I'm looking forward to seeing you in March, and you take it away. Oh, you listen, one last thing. What I was trying to say in the beginning of this is that we're never about trying to change someone's trading style. What it is, it's about looking at what other people use at work. And that was another question that the Pitbull asked me when I first started working with him. It was a very difficult time kind of figuring out who the guy was and what he was about. But one of the questions he also asked me is all the winners. And at the time, we were doing Tudor's business, we were doing Soros, we were doing Louis Bacon, we were doing all sorts of big business. And yes, we followed the winners. And today, I believe I still follow the winners. And I think some of the people that you're going to be seeing and talking to today fit that same thing. They're winners. Thanks a lot, Jeff, and take over.
Can you guys hear me okay? I know, Danny, thank you very much. There's a couple of people getting some feedback and stuff, and great. Danny is not using a headset, and I thankfully am. But I think there's some internet stuff going on out there, especially with the weather here in the East Coast. So welcome, good morning everyone from snowy New York. I understand Philly's pretty buried. We're about to get it. There's been some issues going on here, state of emergency. So who knows if my power will last, but it should. So I have a bunch of slides, but Danny thankfully pulled together a couple other people. So I'm going to end up ripping through some things pretty quickly because there's a lot of people here. And I'm going to rip through it. So hang on. But first, just a quick, make sure I got my driving steering wheel right here. So just a quick little word from the lawyers. This is for informational purposes only. Past performance is not a guarantee of future results. Consult with your financial advisors. Do your own due diligence. Use your head, common sense, etc., so forth. And we're off. As a lot of you know, we've been doing this for about 50 years. My illustrious father, Yale Hirsch, who is 92, down the road in Nyack in his apartment with my mother. He is still sturdy, not quite as sharp attack as he used to be, but no guarantee, Scott. But I just want to give you a little feel for some of the things we have out here. Here's the original 1968 Stock Traders Almanac, the first edition. Yale started this when I was born in '66, or a few months before I was born. The 2016 is out. I've got the Super Boom forecast book out. Came out in 2011 based upon a forecast I made in 2010 based upon a cycle that Yale and a trend and a pattern that Yale discovered in the 70s about these 500% moves after war and inflation, and we'll see that. And then there's the little book, Stock Market Cycles, which is a nice little quick, fun, sort of sophisticated book for dummies style thing, the Whaley little book series, covering many of the cycles. A little trip down memory lane. This is the forecast T-shirt, the Dow 3420, which Yale put out in '76. This was T-shirts we handed out at some seminars back in the '80s. It rhymes with my Dow 3820, 38820. I think I skipped a slide. Did I not? No. Anyway, there's a picture of Yale on week in '78 after he made this forecast. Kind of a proud one for the family. A little shot of me. You'll notice there's a bit more hair here, though it's starting to go. This is about 10, 15 years old. Me and the big guy at our old office. And some of the places where you can find proudly and humbly a lot of our commentary. People pick it up out of the book. I have the privilege of getting interviewed and appearing on many different financial news outlets, and it's sort of a testament of the recent popularity and efficacy and accuracy of all these seasonal cycles and trends. A lot of people are jumping on. The people in this room and and on this panel are already proponents of. One of our guiding lights is sort of the flip side of the George Scientific quote, "Those who fail to remember the past are condemned to repeat it." We like to think that those who study market history are bound to profit from it, but as our good buddy Sam Stovall likes to remind us, we use history as a guide and not a gospel. Nothing's ever exactly the same, and it's just, use history in conjunction with other things. So 50 years analyzing, researching, and testing. I've found out recently there's several other things I need to look and test. I think Mr. Whaley, who I spoke with earlier, has some interesting wrinkles on and additions and building and standing on a lot of the work that Yale did and I've been doing, and I'm looking forward to seeing that. So there's a few things we still need to look at, but we've been publishing it annually in the Almanac. The 49th edition is out there. I am 49, so I am the same age as the Almanac. We update it weekly and monthly on our website, and we do use it to construct portfolios in our newsletter and also with the fund that we work with called the Probabilities Fund. I'll give you a little bit on that in a bit. Whoops. Use the arrow up here. So our process, cycles, seasonality, recurring patterns. We look at the current trends of the economy, monetary and government policy. There's a little bit about the Fed in a moment. I also look at some old school internals, breadth and new highs and lows and even sentiment, put call and that sort of thing. And when we pick stocks and sectors, we do look at fundamentals. We do a nice fundamental stock screen and some basic technical analysis, chart pattern recognition, pivot points, candles, all that kind of stuff, amongst other things. So the major cycles that we look at, war and peace in the markets and the secular bull and bear markets kind of run together. That's the sort of the basis and part of the super boom forecast, the 500% move following war and inflation. The decennial cycle, not so much for us. The 50-year, has the best gains. We didn't get that last year. It's now 12-2 because we had a loss in 05. But the 4-year cycle is something that we are proponents of. not something that we necessarily invented. It's sort of evolved. There was things that were on that, you know, years ago, but Yale really put it all together when he started the Almanac. And the one thing that I think is imperative and really crucial for this year is how the two-term presidents are different when we have a sitting president in office during the election year, second election year, the 8th year of the terms. Seasonal cycles for the best 6 months, you know, sell and may go away, which we don't necessarily go away, but we do the best, all the cycles for different sectors and commodities. Stuff we're not going to get into is all the different quarterly, monthly, daily, weekly, intraday patterns. Have time for all that, but the January indicators we will look at. So back in 2014, December, we made a forecast looking for the usual 50% move from the midterm low to the pre-election year high to be below that range, more like 20 or 30%. We thought that the economy was prone to slowing in the second half of the year as the election campaigning heated up. We expected a high in the first half around 2015. 2015 around Dow 19,000, 2250 in the S&P, and 5,000 on the NASDAQ, and then it's moved sideways for the last half with an ultimate high at year end. Well, we didn't get that ultimate high at year end, but we did make new highs, cleared 5,000 on NASDAQ. Looks like we did top out there in the first half. We were up 19%, and the economy is arguably slowing, so all in all, not perfect, but not too shabby on an outlook that far in advance. One of the things concerning us here is the first losing pre-election year for the Dow since 1939, when Germany invaded Poland, and the 2 years after that are down quite substantially. So this is not a good sign. We've got a little comparison on this chart. The 7th years of terms, we talk about the two-term presidents. You've got the pink and green, or just the average from 1950 to 2014, and then since 87 crash. This is the all pre-election years in blue, and then 2015 in red. You can see how it tracked below everything, ended up in the red. Very disconcerting on top of a lot of the other things that are going on in the market that has our you know, our radar purring. So a quote that I like to use when I'm talking about seasonality as an indicator and not a tradable strategy, and Edson Gould, I don't know if anybody remembers him. He had a letter back in the 80s and before then. So he said, if the market does not rally as it should during bullish seasonal periods, it is a sign that other forces are stronger. And then when that seasonal period ends, those forces will really have their say. You can see right here, right now, here's a of from Trade Navigator of our best 6 months buy and sell signals using MACD. And you can see that right now we were looking pretty good, and now that we've fallen through here. This is, people will say that the best 6 months doesn't work. It doesn't work every year, but this is a sign that things are off. And when we had this kind of situation in 08, we referenced what happened in 73, 74. And, as we progress through this quarter, if we can't get positive for the best 6 months, I think we're in for further downside later in the year. The Fed tightening cycle seems to be squeezing the market. Here's an average since 73 of all the tightening bases, 30 days leading up, 60 days after. And you can see that currently the market is following this pattern, the direction, the trend, but the level is much lower. Again, not something that has me enamored with, the current picture for the stock market. So Santa Claus should fail to call, bears may come to Broadenwall, a nice phrase coined by my illustrious father, Yale Hirsch, also a songwriter at heart. And just a review that something that he invented in 72, along the time when he found out discovered the January barometer, is that the last 5 days of the year and the first 2 days of the new year, the 7-day period, is something he called the Santa Claus rally, which is usually up about 1.5% of the S&P, as all the retail people kind of are off with family and holiday stuff, and the professionals are trading and buying up oversold stocks for tax loss selling. You can see the last several times that Santa Claus failed to call: 94 flat, 2000 bear, 05 flat, big bear in 08, and last year not again. So the first of our January indicators to add to the con column for 2016. Here's a look at our January indicator trifecta, the Santa Claus rally, the first 5 days, January barometer. These are all times when we had the Santa Claus rally down, the first 5 days down, and all but 85 had the December low violated. I don't know if anyone follows or listens to Jeff saw it, something that he learned from Lucian Hooper back in the 70s, that when the Dow closes below its closing December low, it's a watch out signal. And you can see the point here that when, if we can turn positive this month for the January barometer, which is the full month S&P performance, as January goes, so goes the year, it sort of adds to the plus column of the potential for positive, some more positive action. We had some bull market years. 05 was one that was a bull market year, had a losing January. But you can see when you have these negative situations crossing below December's closing low, down January's, you're looking at kind of bear market situations over the past occurrences. But January coming into the month, we were concerned about the volatility. We've had a lot of losing Januarys. It seems to be profit taking is sort of really rolled over into January these days. So the action here is critical. I think next week is even more critical. We've got our indicator trifecta. We got down Santa Claus down first 5 days, waiting for the January barometer to come in. We blew through December low. We didn't have a January effect, which we found really starts in December. The tendency of small caps to that's the Dow's December closing low, not the S&P. I'm just looking at the chat on the side over here. So the Russell 2000 is lagging. No January effect. No small cap outperformance. Again, I'm looking for good signs. Having trouble finding them. Here's something that comes out of the 2016 edition. One of the reasons back in June when I put the Almanac to bed, sent it off to the publisher, that we were concerned. Here is all presidential election years, and here is 8 years of a president term, the second election year. Kind of a disconcerting angle. Words. We've had this is the S&P up here, slapped in the Dow percentage for perspective. The only up year was 88 when the first Bush won as a sitting vice president. Otherwise, the market averages 13%, minus 13.9 on the Dow, and about minus 10.9 on the S&P. So, something that had me not looking at 2016 very positively way back. A little bit of a Dow theory sell, not a huge follower of it, but when you see back here, when the Dow starts to take off, the industrials, the transports do not. We've got the transports down, full-fledged bear market down 28%. This is a Dow theory sell signal, another negative. So, and then something I put out, got a little traction on the Twitter, our blog, which feeds to Twitter. That's Almanac, @Almanac Trader. If anyone wants to check it out, it's all off the website, as you can see down there, stocktradersalmanac.com. One of the things sort of went different than other people. We declared using Ned Davis research definitions of bear market back in 2011 because his criteria are 13% down 13% over 145 days constitutes a bear market. You can see that was the case back in some of these other periods like 53. I've got a few other bear markets which we all know we had one in 87 and 1990 and 98. They were 30% reversals in the value line, as well as 20% on these particular days. That the 98 bear market is how that sort of gets qualified. So the point being here, of these 17 different instances, you've got 53 stopped, a bunch of them that are not too much further down. A lot of them wrapped up pretty quickly, and you've got about 6 of them that went a pretty decent amount of time, and some serious bear market years in the 70s, and then again here in the aughts. So odds are, we've seen the bulk of the move down. I was never expecting anything more than a 20 to 30% bear market. Starting sometime around the next few years, it looks like it may be upon us. We still could get a push higher in the spring and then roll over. Sort of brought us, to that super boom forecast that we made, and we finally get back into another really bull market. So I got a little picture of this bear because I tried to put a whole bunch of stuff in the pros column. January sale has a chance. We're still in the best 6 months. We haven't quite blown through that August support yet. It is an election year, But on the con side, the negative side, the Fed's tightening, first down protection year, the 8th year of the term. We had this descending flag was kind of long for some of you technicians that was busted to the downside. The economy is kind of slow. Dow theory sell. December low violated. Santa Claus rally didn't come. Ned Davis bear market, and all the other situations going on out there in the world. So, you know, not a beautiful picture. Just giving you a quick look. I'm going to breeze through some of this stuff because we've got a bunch of people who are going to speak about other things. Some of the positions we have using your sector seasonalities. Got a bunch of things being stopped out. Our stock portfolio, you're going to see a lot of red stuff here because this is our free lunch menu for anyone that follows it. Or we pick new 52-week lows at the end of December. Got cleared out of a lot of things. That's why we have stops in place. But you can see that, you know, our gain since we started is about 20%. And then the same thing with the mid caps and large caps. But over the long haul, since we started this portfolio in July 2001, this is hypothetical, of course, we're up over 200%, despite some recent red numbers in this, you know, down market draft here. The current things that's to give you a little current trade is this oil trade. Everyone's been, you know, talking about oil every day, all the time, but we're getting a bit of a seasonal setup here. So potentially, we had a nice trade here last year from January, February up to here. This trade kind of tops out a little bit more in May now. So it looks like we're setting up for something like that, and we're looking at, you know, a position in either USO. I think we're in it below $9 if for those of you who trade ETFs, and the other ones of you out in Chicago and New York who do futures. It's a decent opportunity right here. So our outlook and forecast. Every year, just before triple witching and Christmas, when we usually take a little break, we put out a forecast. And we look at what we call the 4 horsemen of the economy every year: the Dow, the unemployment rate, inflation, consumer confidence. We also look at housing. And, you know, the Dow was looking a bit better back in mid-December when we looked like we were starting to rally. And the aforementioned Mr. Jeff saw it, was on CNBC looking for a rip your face off rally, which he's admitted that he's been wrong a couple times before. But I happened to catch him at lunch one day on CNBC. So, you know, with all the stuff going on in Saudi Arabia and Iran and ISIS and you know, China, there's a lot of things that are weighing on the market. So let's look at some of the numbers. Back here, the unemployment rate looks pretty solid going down here, but this labor participation rate, you can see the gray bars are the, you know, typical recessions that we have laid out over there. I've chopped this chart up a little bit for presentation here. So, you know, this participation rate is showing that the economy is battling to you know, expand. A lot of the people, sorry about the audio there. Sometimes it's an internet connection. Maybe I'm screaming here. Let me just tap my volume down a little bit. But, you know, a lot of the oil jobs that are being, you know, going away seem to be ending up in healthcare and what have you, which we think is probably sector of the future, with or without Obamacare, which gives everyone a little agita. So inflation, you know, doesn't exist. Perhaps, you know, this market correction will you know, help the Fed in its tightening. It may not need to go as much. So, you know, this is a concerning situation. Perhaps we'll be able to find some inflation, which we'll need a little bit of, but again, not one of the positives for us right here. Consumer confidence up above that 90%, that 90 level, that is comforting, but hesitating down, looking like it's about to come through here. I think I'm even cut through there a little bit. So the Dow we already looked at many different ways. Existing home sales, they kind of remain on the rise, along with housing starts. This is, you know, the first bastion of hope with the economy, but you look at starts and it's kind of still lagging, so not really getting much traction. Concerning here. New home sales, kind of still the hockey stick, laying on the ground, laying on the ice, not really taking off like it does in an economy. So this is like the last indicator that we were looking to when we really entered that sort of, real boom period. You can see how it sort of comes up in this trend above this line here, and this will be the last indicator to really convince us that we're in a new secular bull market. The HMI, one of the first ones to really show the market breaking down in 0506, kind of a leading indicator. It's above that 50 level, but it is starting to break down, or maybe it's rolling over. So this is a bit of a concern as we start to head back towards that 50 level. So some of the things that we look at, the internals and such, this is updated through the end of last week. I did it earlier in this week. We've got a nice Friday trade here. So some of the things that we look at is down Fridays and down Mondays. You can see them bold. We had a nice is the wrong word. We had a pretty solid down Friday, down Monday, which is a warning sign. You can see us going out further. We're not getting that Monday sell-off after a couple of bad Fridays. That's encouraging. We had a good Friday yesterday. We've got a bunch of red marks here. Some of the troubling area here is the massive amount of decliners and the massive amount of new lows. And again, put call up at 93, back towards the levels we saw in November and back in August. But the last time we hit something like this, I think, was back in 2011. Interest rates, not really indicative these days. Thanks, Dan. So again, just a reminder of the down Friday, down Monday thing. A little footnote here, like the Tuesday after Martin Luther King holiday gets counted as a Monday. It's a first trading day and a last trading day of the week. So when we have Good Friday, the Thursday is a Friday, just for technical purposes. So our forecast, back in June when I wrote the Almanac, if anyone's got a copy, you can to page 6. I've got my trusty one at my side. My comment, less than sanguine about the prospects for 2016, because we were looking at this average election year. It's now the worst performing year of the 4-year cycle since World War II. We've been getting on the chin with undecided elections in 2000 and financial crises in 08, flat years in 04, and the 8th years is the issue. I showed you the slide earlier. Average down 13.9%, down 5 of the last 6. The one that was up was only up a couple, 3%. So back in December, was 17th or 18th, whatever it was, we felt that if the commodity price decline was transitory, like the Fed thinks, and prices stabilize, we could get those average election year gains around 4.85%. But if it's wrong and commodity oil suffers further, junk bond unravels, amongst other things, we may begin a mild bear market, and we're sort of on the cusp of that. And by the Ned Davis definitions, we have already entered a mild bear market. So we will wait and reserve the right to wait for our final January barometer reading at the end of the month in conjunction with the down Santa Claus and down first 5 days, as well as all the other economic data. I don't think Mr. Obama did anything but fan the flames of negativity with his State of the Union. Not a great sign. Trump is leading. I would say with the way that the stock market is forming this year, I would bet the Republicans would take back the White House in November. It's a very typical incumbent victory, incumbent defeats thing, a page out of the Almanac as I look to it over there on the left. Market does much better when incumbent parties win, and you can use that if you want to bet with your friends and colleagues for that steak dinner about who wins the election. So the next bear market may have already begun. As I said, the Ned Davis version has. We're looking for a low into 2017, 2018, which we'll see in the chart in a second. But I don't think it's going to be the generational bear like we had in 08. That usually comes once a generation. I don't see us cutting the market in half again. These calls for Dow 6000 by the usual perma bears, I think are unfounded. And but I do expect something in the 20 to 30% range. And with the action recently, the 25 to 30 is becoming a little bit more possible. So we don't expect much upside over the next few years, but after this next bear market, our super boom forecast kicks in, and I'll show you that here. And just, I think I'm one of the few people that still believes we're in a secular bear market. I have a couple other slides that not on this particular, piece, but that show the different periods of secular bull and bear. And this is a chart that I've built on what Yale did, and in the back of the Superboom book, there's like original copy of his chart, which was more using Sharpie on transparencies. But this is showing the great, if you can see that, in World War I, World War II, Vietnam, War on Terror, as these secular bear markets. Most people will agree that 1982 over here, if you can see my mouse moving, was the beginning of the secular bull market in the end, not 74. So beginning of the secular bear market, I think, is inconsistent with historical patterns, and I expect another 1982 moment, which we may very well be underway. But you can see with inflation going up for World War I and World War II and Vietnam, you've got these 500% moves in the Dow, and even more, like closer to 2000, 1500, 2000, after the 200% inflation in the 70s, and also the information revolution, which, part of the whole process here is that when you take the war, the inflation coming off, you have functional political activity like we had with Reagan and Tip O'Neill, and maybe even arguably Clinton and Gingrich. And then you add this, something I call the culturally enabling paradigm shifting technology, like the automobile that was part of the Roaring '20s, like the television and the military industrial complex and all the appliances and all the technology that came out here, and of course the microchip, the internet, TCP/IP protocol, all that stuff that drove the information revolution. You go back further to the train, indoor plumbing, and what have you, and you can see that where it's something that's part of the driving force, and we don't have any political functionality here. So when I put this forecast out in 2011, Whaley, my publisher, asked me to put some sort of, not promotional, but just explanatory information together. So I had the black line, monthly closing prices of the Dow Jones Industrials. This is actually, that should be, this is through, the black line now through last week. And I drew this blue line using some George Lindsay, some Ned Davis, a lot of Yale Hirsch, a lot of Almanac, a lot of secular bull and bear market, a lot of four-year cycle, a lot of seasonality within all those. And I laid out what I thought the picture could be back in 2011 going forward, what the projection was. Not necessarily a forecast, but sort of a projection. And then QE kicked in, QE1, QE2, Operation Twist, QE3, and I made a couple of different changes to the sort of raise the floor. January 2014, I pulled it up, July 2014 again, and last year. And here's the current Dow, sort of tying in with it, almost like one of the hurricane forecasters, the different models, if you will. But we are sort of on track. We didn't get as high as I thought the last time, but we ended up about as high as I had imagined in 2014. And I think we're going to be tracking along this pattern. Not exactly, but when we get a little inflation, we've got some now. Yeah, the aging population thing, that's very Harry Dent, and I'm not as convinced about that. People are living a lot longer. My father is a testament to that, and the millennials are spending more. So I'm not sure the whole end of the baby boom is going to be such a detrimental impact on the global economy, and the fact that it's global, and we also have can have an immigration boom once we get that squared away. But so once we get some inflation, it levels off, we get some, functional action in Washington, maybe after the next midterm election in 2018, I think we'll begin the super boom and have a whole bunch of years of double-digit gains that will compound and get us up to 38,820 by 2025. So there's several ways that you can leverage the probabilities with what we do. You can use the Stock Traders Almanac. You can get anywhere books are sold. We have a website, stocktradersalmanac.com. It's our newsletter now. It's a digital subscription service. We do weekly research analysis and send out signals and alerts. We pick stocks and ETFs, which you options traders can dance all over however you want to use your option strategies, and I have a special offer for you guys with 20% off the 1-year subscription. MTS16 is your code. And I'm also on the investment committee for Probabilities Fund Management. They run a mutual fund based upon the Almanac, using S&P ETFs to time long and short with a whole calendar based upon all of our probabilities and different indications. They have some rules and strategies. They also started a long short sector rotation fund using our sector seasonality patterns, amongst other things. The Almanac, that's done well. You can find out all about that at probabilities.com. And this month, unfortunately, but fortunately, we started our Almanac Traders Picking Fund. I normally only get really long in, August, September, October, and start to take profits in short in, March, April, May, June. So the timing of it to begin a fund of the year was not great, but I think we'll have an opportunity to really prove that. And that's using our fundamental screens. We use Zacks and Market Smith, and also Trade Navigator and other chart places to find stocks that have relative outperformance and great fundamental numbers. So there's the Probabilities Fund Management website if you want to learn more about what we do there and the different offerings. And in the interest of time, I'm just going to blow through here. As Danny may have mentioned, some of you earlier on the phone, I'll be down in Florida on the 5th. I'm going to head down to Delray, hook up with Danny, and I got a little investment club down there that I'm going to speak to after the money show. I'm doing a 2-hour seasonal investing event, and then anyone needs me, just give me a holler. I'm pretty available for any sort of thing, investment workshop, investment clubs, client events, conferences. And with that, I'm going to say thank you and give it back over to Danny. And how did I do going through 45 slides quickly? Back to you, Dan. Thanks, everyone. I'm going to mute myself and give it over to Danny.
All right, Jeff. Thank you so much. You guys can hear me, right? Really cool stuff. I mean, I think at the end of the day, let me turn this down. I think at the end of the day, there's so many facets of trading. You have to open up your mind. You have to open up your playbook. You have to open up your toolbox. And I really do believe in this. Years ago, show up on the trading floor, have a bunch of orders on the desk, try to do some trading. It was pretty simple. You didn't have all this algorithmic and program trading, and things have become a lot more complicated. And I really, really, really do believe in Jeff. I think he's a solid guy. I believe in the research, and I think that it's something that if you've not followed up on in the past, I really think that you should give it a shot. Give it a look. Listen, before we move to the next guest, Wayne Whaley, and I want to, if somebody from my group could put up the Winter and Leicester website link, that would be nice. I just want to tell a quick story about how I know Wayne, and I think it kind of plays into what all the stuff that's going on at MrTopStep and why we're trying to reach out to so many people and why we're trying to pull all these smart people together. It's to try to help educate people. It really is. MrTopStep isn't, we're going to be talking about our boot camp, but we don't make any money by doing this today. We're doing it because we love the markets. That's why we do it. Period, the end. So anyways, back to Wayne Whaley. Wayne works at a company called Winter and Leicester. And years ago, when I was at the old CME at 30 South Wacker, before we moved to the Board of Trade, my desk butted up against another guy's desk. They were called the McDonald brothers. And I think Wayne would be laughing about this right now. But I was kind of rough back then, and the McDonald brothers were kind of a target. And sometimes when I would come, in half-cocked, and I had the McDonald brothers over there, and they were doing their stupid stuff, I'd kind of go after them a little bit. But anyways, we tried to get the Winter and Leicester business for a long time, and then we just gave up. But I got to know Wayne, you know, by talking to him, and I found out that he was a research guy, and initially he was a trader, but he has a partner, but at the end of the day, he's doing the research, and as he was back then, live trading with real money, he is actually still, Winter Lester is still a trading firm. He's still doing the research, and he's still trading today. And there's going to be some very stark similarities in what Wayne's going to talk to us about that there was with some of Jeff's work. But it was interesting today because Wayne and Jeff for the first time met. And Wayne will tell you about a little bit about his background. He's been looking at Yale Hirsch's stuff since, I think he said 1989 or 1985 or 1979. I don't know, but it's a long time. And what he's done is he's developed some of his own methodologies of how to use the information and kind of expand it out a little bit. So it was kind of interesting to put the two together because I think at the end of the day, this is another example of how two very, very smart people that share something in common are going to probably get together and talk again. I think that that's really cool. But anyways, listen, I'm going to turn it over to Wayne. Wayne, thank you very much for coming in. I'm going to jump off and let Wayne take over. Wayne, are you here?
I'm here.
Okay, cool. Thank you very much.
I'll talk for a few seconds and make sure we've got our volume the way we want it, and decide if I need to yell or if I can talk normally. Is everyone hearing me okay? I know some of you will not. I noticed when Jeff was speaking, I heard him perfectly, and a lot of people didn't, but the main thing here is, am I going to be able to...
Hey, Wayne, real quick, I just want to interrupt real quick, and I'm sorry. You know, I don't know, I got to turn my volume down, so I can't hear it all, but can you do a little background on how you got in the business, what you were doing, you know, what you went to college for, and how this all came about, so people can understand this a little bit?
Sure, love to.
Okay, thank you.
I have 5 charts. I have 5 charts to talk to, so I think we have time to do that. I'm 57 years old. I actually went to a small college in Alabama, Jacksonville State University, with the intention of being a school teacher, maybe possibly a sports coach. My father was a coach / principal, and I had played ball in high school and they were the role models in my life. And my father told me, if you want to be a teacher, you need to get a degree in math. And if you get a degree in math, you'll never have any trouble getting a job. So I went to college, and it's a funny story because I went through all the calculus and math, and I entered the education program my junior year in college, and I got about 3 or 4 courses into that, and I had the semester I was supposed to go observe a high school class, and I was sitting there observing all day, and the 8th graders walked in, and I thought, you know, I have really busted my butt studying 4 semesters of calculus. I'm not sure I want to deal with these guys. So I went back and I talked to my counselor at that time, and he said, why don't you take a programming class this semester and see if you like it. So I took what was called Fortran at the time, and I said, yeah, this is what I'd really like to be doing. I'd like to be using math to solve problems. So I busted my bottom trying to get some kind of computer science minor in the last 2 years so that I could catch up with the engineers. And I went on and went to graduate school at Georgia Tech. And at Georgia Tech, I got a degree in something that's called operations research. And I didn't really know what I was going to do with it, but I really enjoyed the curriculum. It was a lot of probability and statistics, a lot of mathematical modeling, simulations, and probabilistic models. And I didn't know it at the time, but it was really setting me up to do the things that I'm doing now. It's perfect for studying the markets from a different angle than the fundamentalists do. So I came to Huntsville, Alabama, trying to stay a little bit in the South and stay at home. And I came to work in Huntsville, and I spent 12 years working in the defense industry. And during that time, I didn't have any money growing up. And after 5 or 6 years in earning a little money, I started to invest it, trying to save up for a house. And I quickly realized that the local stockbroker didn't care as much about my money as I did. So I said, Wayne, you know, you're a smart guy. You need to study up. So I started buying every book I could on stock market timing, probably like a lot of you guys, 25, 30-year-old guys in the audience. And when I started reading these things, they would throw out different type of mathematical models. And my thought to myself was, you know, Wayne, you have the ability to test these theories. And I would read everything that I could and go home and study these different ideas. And what I found out was 3/4 of them didn't really work very well. Yes, they worked on the 2 or 3 examples in the book, but if you tested them over a 30-year period, they either worked real well in bull markets or real well in bear markets or something like that, or sideways markets. But so I started playing around and trying to test everything I could get my hands on. And in the mid-'80s, I ran across the Stock Market Almanac by Hirsch. And I started studying. I gravitated toward the seasonals because I was a bean counter at heart. I loved playing with numbers and I loved crunching them. And I started trading, and I got more and more interested in this, and it was a perfect application of my education. And over time, I realized that I had to do my current employer a service and get out of that business and go do what it was that I loved. So in 1993, I attempted to turn a hobby into a career, and after talking to different people in North Alabama, I ran into a couple of guys here that were doing futures trading, and I said, hey, let me come aboard and do research for you, and let's see what we can do. And then a few years later, I became a partner in the firm. Now today, I have some stuff, and I had been wondering, I'm down here in Huntsville, I'm not really glued into the network, and I'm content trading money for a handful, dozen wealthy individuals and making a decent living and writing commentary for those people. And I had wondered if the Stock Almanac guys had ever run across any of my work. And as Danny mentioned, I got to talk to Jeff a little bit today because I have taken some of their work and tried to build upon it a little bit, and thank goodness for them. I basically, today, I trade 14 different markets, and I get what I call a Hirsch dump of the seasonals every day on 14 markets when I come into the office to go through, and I look for that one market where everything kind of lines up right. So that's a little bit of my background, and I'll go into the 4 or 5 charts I have to talk to you about. It's interesting, Danny asked me, I think it was Thursday, if I wanted to throw something together, and I said, I don't have a presentation. Here are 4 or 5 charts that I've been talking to my people about. Take them if you want to throw them in PowerPoint, and I'll talk to them. And as I was listening to Jeff's presentation, I really think it's a perfect supplement to what he was talking about, because you're going to see, I mean, you're almost going to think that he and I collaborated on putting my stuff together, but we didn't. We came to this independently. So that's the background. And yes, Amy, I'm going to talk about the toy barometer in just a moment. And I will talk to each chart, and then before I go to the next chart, I'll look down and see at the comments. If you have a comment that you think is interesting to everybody in the audience, I would encourage you to ask. If you have a specific question for me, I would ask you to wait and Gmail me later, and we will talk about it. But I'll come back at the end and give you my Gmail address here again. But let's go to the first chart. Now, isn't this interesting? Jeff alluded to this and talked to it, but it was the first chart in my presentation as well. I started telling the people in mid-December, I said, you know what, guys? We've had 18 straight positive or non-negative pre-election years, and we may not put together one. And as Jeff talked about the trifecta of the Christmas deal, I refer to that as the turn of the year. I have the toy barometer that I'll talk about on the next chart. But I said, you know, we started last year with a really bad turn of the year, a really bad toy. Now we're having a negative pre-election year, the first one since 1939, and we're halfway into putting the 2016 toy or 2016 turn of the year, and it's not looking too good. This idea of a negative pre-election year sandwiched between 2 negative toys, just for people who look at the kinds of things that I look at, and obviously the kinds of things that Jeff looks at, this doesn't give me a good warm fuzzy feeling. So on this chart, what I'm showing is that we'd had 18 straight non-negative years. And if you go back up there and look at it's been a long time since we had a negative one. In 1931, we had a negative one. And you see the following election year in 1932 was pretty ugly. And in 1939, we had a negative election year followed by a negative pre-election year followed by an ugly election year. And actually, if you go through and look at these 6 election years that were negative in the right column, the 6 that were negative, I think 5 of the 6 were preceded by below average pre-election years. So this is not something that makes me want to go all in short. It's just kind of a red flag and says, everything's not hunky-dory here. We need to be alert here. We need to be cautious. All right. Okay, the turn of the year barometer. Now, first let me say that my desktop is covered with about 50 icons of studies that I look at during the day. I rely on probably 50,000 lines of code that I have written myself to give me studies on everything that you could possibly think of on 14 different markets. And I go through those. And I most likely have way more information than I need. But I have shared the turn of the year barometer because it's so simple, people understand it. And actually, if I had to narrow it down to one indicator that I would follow and make one trade a year, it would most likely be on the turn of the year barometer. Now, again, I'll repeat myself a little bit, but I've been following the January barometer for 20, 25 years, maybe 30. I think I'm older than I realize. But I always had on my to-do list, you know about the January barometer. What about the other 11 months? What kind of correlations do they have with the following 12 months? So I finally got around in March of 2012. I sat down and I studied all 12 months. And when I finished that analysis, it was pretty obvious to me that there was a good reason why Yale and the stock Almanac guys had come up with a January barometer, because it was clearly the best of the 12 months in forecasting the next 11 months. And actually, the only other one that had any kind of correlation to the following 12 months was April, which is a distant second to January. But I thought that was interesting because January is earnings seasons, and April is earnings season as well. So I thought there might be something interesting there that I might need to look at again someday. But January was clearly the strongest month for predicting the next 12. And then I said, there's this thing about the first week of January, and then the Christmas rally, and the Thanksgiving rally, and the Santa Claus rally. Why don't you study all those? And I said, gosh, Wayne, stop it. You've got all the data. So I took some time. I wrote 100 lines of code, and I asked the computer, I said, computer, please help me here. Go back through and study every time period during the year, from 1 week, 2 weeks, 3 weeks, all the way up to 3 months, and find me that period of time that has it has the highest correlation coefficient to the next 12 months. And there were a bunch of them right up there at the top. I mean, I came out with this period of November 19th to January 19th that I called the toy barometer. And guys, I really had no idea at the time what I was on to in 2012. I've been using it every year. I give it a good, thorough scrubbing, and I get a deeper and deeper appreciation for it. For example, the toy barometer, the S&P performance from November 19th to January 19th. There have been 33 times since 1950, which is the 65-year period I tested. There have been 33 times where the toy barometer came in at 3%. And in 32 of those 33 occasions, the market was higher 12 months later. So you'd really like to turn the year in good fashion, which we haven't done this year, and we didn't do last year. And a little interesting tidbit there, I say we're 32-1. The 1 year where we had a failure was 1987, where we had a very strong toy in 87, something like 10%, I want to recall. And actually, after that toy, the market went up another 25% into the middle of August. And then in that fall, if you're over 50 years old, you remember 87 well, we had that assault on double-digit interest rates in September, October that just collapsed the market, and we had Black Monday. But the market, initially, toy was on top of it. We did have a run-up. And then you can't just rely on seasonals and toy barometers. at that time, I remember I was a big follower of Marty Zwag's work, and I knew that monetary conditions were turning ugly, and we got to 100% cash by October in my little investment club at that time. So you got to look at a different genre of items to help you guide you. But you don't need too many. That's something else. You need a handful, but you don't need too many, because when you get too many, what happens is the ones that really matter don't get enough weighting. So if you look at the table on the right, you'll see the green row on the top. I have 3 layers of toy barometers. The green row, any toy over 3% is bullish. And this is, again, understand this toy is that trifecta that Jeff was alluding to. Why did the model pick out November 19th to January 19th? Well, you get the first week of January, you get the Christmas rally, you get the Thanksgiving rally, and at the turn of the year, you got a lot of people making end-of-the-year contributions, first-of-the-year contributions, which kind of tip the market's hands as to what may follow in the next 12 months. So there's a lot of important things going on there at the turn of the year. The turn of the year is important, and you really need to keep your eye on it. Now, I have 3 different categories. The bearish category is if you get a negative toy. Okay, that's the bottom row there, the red row. If you get a negative toy, the next 12 months, and I defined a toy year, 12 months, as January 19th to January 8th, because January 19th is the termination day for the toy. The next year is 4 and 10 after a negative toy. Okay, and you say, well, 4 and 10, that's not nearly as good as the 32 and 1. You have to naturally, as Jeff appreciates, you have to keep in mind that 75% of years since 1950 are up. So it's hard to forecast accurately bear markets. But a couple of things to keep in mind, and I just put out a paper to my commentary subscribers called the 2016 Toy Story, the ugliest toy ever. We just put down the ugliest toy of all time, which 9.6% toy, which eclipsed the 2008 toy, which was the former previous ugliest toy of all time. So we're not in very good company there. Now, don't get me wrong. I'm not forecasting a 50% bear market, but there certainly has been reason for caution. And obviously, the last couple of weeks have been in agreement. But a couple other things about the 4 and 10 toys. In 13 of those 14 toys, the January low was violated by the monthly low of one of the following months. Also, in 14 of those toys, the following my defined sell in May period, which happens to be May 5th through October the 27th. 12 of those 14 sell in May periods were negative after the 14 toys. 11 of those 14 negative toys had a 10% decline at some point in the next 12 months, counting from the January 19th. And all 14 of those negative toys had a peak to trough drawdown of at least 9.7%. 13 of 14 had an intra-year drawdown of 9.7% or better. So that's where I am with the turn of the year. Okay? So as I mentioned, I put together a 6-page paper that I sent out to my commentary subscribers. I'm going to share one of those with you. We have actually had 17 consecutive winning toy barometer signals. Now, I mentioned that anything over 3% is considered bullish, anything over 0 is considered bearish, and I consider the 0 to 3% toys to be non-signals or neutral signals. You're going to have a hard time reading this, but let me, because it's kind of small, but let me tell you what I've got. On the left column over here, you have the non-neutral toy barometer signals since 1950. Okay? There are, I want to say, 49 of them, 47 signals. In the left column, you see the toy barometer signal. In the next column, you see the 12-month performance in the toy year that I refer to. And if you define in statistical experiments, we learn to call an experiment outcome either a success or a failure. So if the direction of the following 12 months is the same as the direction of the toy, I define that as a successful test data point. Otherwise, it's a failure. So you can see 17 successful toy barometer signals. And think about this. Now I've got a comment column over here. When I mentioned to you that every year I do this analysis, I get a deeper and deeper appreciation for the toy barometer. I didn't really know what I was onto, but each year I've become much more fonder of it, and it's actually my favorite child now in terms of indicators. But look back to, it's called the last two 50% bear markets. In 2007, 2008, we had a negative toy of 7.5%. We were followed by a negative 35% year. In 2001, 2002, we got negative toys preceding the .com and the 9/11 bear markets of those periods. And as I mentioned, if you go back to the previous failure, it was 1987. Go back to 82, 83 was the failure before the 87 failure. In 81, 82, we had a minus 3.9% toy for a down year. And again, those of us that are old enough will remember in 82, the market tanked in the first 7 months of the year. We actually had a 11% decline from January 19th to August 12th into August of 1982. And at that time, there was the Iran hostage crisis resolution. And the market turned around, and we had an election, and Nixon took over for Carter, and things turned around in the second half of the year. But I've really only had one, what I consider terrible, ugly toy barometer call, and that was in 1978. Even if you go back to the bear market, sometime if you can read over the comment list, you'll see the other failure in 69, 70. We actually had a 22% move in the direction of the negative toy signal before the end of Vietnam and prospects for a resolution to that. So 17 consecutive toys. So that's my two charts. That's my two charts on toy, and I'm giving I'm giving you guys some of my best work here. 42 and 5, guys. Toy barometer signals are 42 and 5, and you know this stuff is kind of privy to a few of us at this point in time. 42 and 5 is, you know, a lot of people need a lot more exotic indicators than toy. This is so simple, but I'll put those numbers up against anything. So I think we'll move on to another subject here. Now, as I mentioned, now I got to do a little marketing. I trade money for a living. I rely on 50,000 lines of code. I'm an engineer by training. So when I came into this and I started reading all the different indicators, and a guy would say, okay, when this oscillator goes to X, you sell, and when it goes to Y, you buy. My thought is, why don't I let the computer tell me what X means and what Y means? So every day I get tons of pattern recognition data. This indicator is at X, and this one, over the last week it's at X, over the last month it's at Y, and what exactly does that mean? Okay, this was pretty good timing for me because it's a pretty good time for me to sell some of my stuff, but we trade 14 different markets. About 3 years ago, I took the 20 years of software that I had developed for trading the S&P, I built databases for 14 different markets and started trading 14 different markets, and we have a very solid 38-month record doing so. You might have heard that Friday, the Nikkei was up 5.8% on Friday. We have only taken 4 trades in this program this year. One of them was long the Nikkei on Friday. And what was I looking at on Friday? Well, I do price pattern recognition, and I hope you can read this. If you look at the top row in this table here, going into Friday, and I'm marketing, but at the same time, I'm trying to teach some of you young guys about pattern recognition. On Friday, the one-day trailing trend for the Nikkei was down 2.4%. The trailing 3 days was 6.59. The trailing 10-day was minus 11.95. And the trailing 21 days was minus 15.64%. So I get a data dump every day for all the markets that I study on how they match up to these trends. And in this table, what you'll see is the 30 best matches to those 4 trailing trends for the Nikkei. And if you look over on the far right column, you'll see that the next day was up. Let's see, how many minus signs? 1, 2, 3, 4, 5, 6, 7. We were up 23 times and down 7 on the following day for an average return of 1.35, 1.36. So I have like 10 different models I go through for every indicator, and I'm looking at these, and I'm looking for that A-plus trade, the one where I have 10 indicators, none of them are negative, the vast majority are positive, and mid-morning Thursday, it was telling me, hey, take a good hard look at the Nikkei today. I'll show you one other pattern recognition that I got on that same day that made me want to go with the Nikkei on Friday. Okay? On Friday, the trailing one-month Nikkei trend was minus 15.6%. The trailing one-month trailing S&P trend was minus 6.8%. And if you go back through history and look at the 30 best matches to those true S&P Nikkei trends, the Nikkei was actually 26 and 4 on the following day. Ding, 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 Wayne. Get on board the Nikkei for tomorrow. All right? And this is really the 5 charts, the 5 data points that I put together. I'm going to go back to the following, so you can grab my Gmail address there. We have a mutual fund timing program, and one of the things I've been telling my people is, look, we can't do a whole lot more for you right now than put you in cash. We don't like this market. Give some consideration to our diversified trading program. We're going to stay in cash, but we're going to selectively look for some trades in commodities. I trade 4 different stock indexes. I trade the S&P, the NASDAQ, the Nikkei, and the FTSE. I trade oil, I trade bonds, I trade the dollar, I trade ags, corn, wheat, and beans, and precious metals, gold and silver. As far as an outlook, obviously, my work has a bearish slant. My work has a bearish slant to it, similar to Jeff's work. And I think we'll be lower 12 months from now. Can we run here? Yes, because when Jeff put up the oil study, I have information that just like sell in May and go away for the S&Ps, we are in a period right now for oil. We're in a 3-month period where oil is 28 and 5 over my oil database over this 3-month period. And, you know, whether we like it or not, all the S&P traders have kind of become oil traders at this time. Every day when I go to put on an S&P trade, I also look and say, what do my oil models say for tomorrow? And if my oil models don't support the S&P position that I'm thinking about taking, I've backed off. 2 of my best trades this year were the 2 trades I didn't take on the S&P trying to buy that dip, but I couldn't get my oil indicators to confirm. Okay, so it won't always be like this, and we know we talked about history tends to repeat. Well, it does, but it's always a little bit different. And right now, you know, 10, 20, 30 years ago, Danny and us old guys will tell you we were all bond traders. The interest rates controlled what we did every day in S&Ps. Right now, we're all bond traders. And yes, we learn from history, but we're in an environment where we have 0 interest rates, and there's not a lot of history to relate to. And, you know, you have to really draw from a lot of resources to put together a really good game plan. And that's basically what I have. You guys got my Gmail. Let me go down take a second and look at it, see if anybody's asked any questions I need to answer. Okay, I think, obviously when the toy barometer is important to me, I think we'll go lower. I've got tape indicators that I came up with just like I did the toy barometer. I've asked my computer to, you guys have all heard of certain tape signals, the classic ones. I asked my computer to go back through history and find me those classic great tape signals that are 29 and 1 over the next 12 months. I have a couple of those, and I haven't gotten one of those signals in the last 3 years. I'm looking for one. If we get a good sell-off and a good rally, maybe I'll get one, maybe I'll come back. I like a lot of people, I don't really like to make 12-month forecasts because I'm just following the road signs every day. I almost took a long S&P position on Friday. I studied all day contemplating taking an S&P position for Monday. At the end of the day, I didn't take it. And I'll do the same thing on Monday and the same thing on Tuesday. I just follow the road signs, read the tea leaves, look at my crystal balls, and when they say turn right, I go right. When they say turn left, I go left. So, you know, if you held a gun to my head and said I had to forecast what the market was going to do, I'd say, well, I can tell you, I just probably have to bet on that it's going to be lower 12 months from now, especially lower by September, October. And yes, we're going to make new lows. We may go down to 1750 this year. 50% bear market would be pretty bold to predict, but hey, we had a toy very similar to the one in 2008, so nothing will surprise me. But like I say, I'll reevaluate every day and just play it as I see it on each day. So Danny, that's really, yeah, I mean, we could get a little oil back. If oil goes back to $35 a barrel here, we're going to have a little 5% S&P rally. But I think we'll turn over and certainly go back down and make lower lows throughout especially in the middle of the year. Jeff, answering your question, I really don't think the magnitude is that important. Most of the negative toys have similar results. Now, as I mentioned, we just had a minus 9.6 toy, which eclipsed, I think, the minus 7.5 toy we had in 2008. Those are our two ugliest. So if you wanted to put together a bearish case, you could say, gosh, those two guys are really ugly, and we're going to have 2008 all over again. But actually, if you look at the 5 worst toys, a couple of them turned over. And one of the things we've had here is we've had back-to-back negative toys, and I only have 4 of those data points. And hey, patience. I'll give you just a little tidbit here, guys, and if you haven't gone away, please listen to this. I'll give you a little on the strongest signal that I've ever seen, okay? The strongest signal I have in my bag of tricks is if you get a negative toy year and then you put together a positive toy at the end of the year, it's one of the most bullish scenarios you get. I call it a Red Ryder BB gun toy year. And so stay with me, hang around, check back with me at the end of the year, but I would stay in cash right now and wait for higher probability trades somewhere down the road. Okay. Yes, the Red Ryder BB gun.
All right. Wayne, that was great. Now, when you take all this stuff, all the knowledge that Jeff Hirsch has, and then you get to take that research and see it from the other side, and see how people made things around, other people's ideas. That's what trading's about, and I think today was a great example of that. Now, Wayne, thank you so much. And I put your email in again. Here, let me put it in there again. And then they have Jeff there, and Jeff, I hope you guys I think Jeff will agree. He's all about trying to go out there and help people. As you saw, he's traveling circuit all year long. I hope the two of you guys can communicate again in the future. I really do. But thanks a lot, Wayne. I I love that. Now, listen, I'm gonna flip these slides forward real quick, and before we jump into our next guest is Bob Michel from the MrTopStep Forum, and and Bob probably thought I wasn't thinking about this, and he was probably surprised that I got a hold of him. But back a couple of months ago, Bob sent me a spreadsheet, and because of my busy day, I wasn't able to really dig into it, but then after a week or two, I started to dig into it, and basically, it's a spreadsheet that shows what money the Fed has on its balance sheet. Now, the funny thing is that these markets, as they've gone up and down, and we've gone from 4 possible rate hikes to the Fed funds on the board of trade floor, CME floor, indicating one rate hike. Some people are saying no rate hikes. And JC, if you could put that link in, there was a CNBC story that came out. Well, I'll have Fair Value Trader put that link in there. Are you there, JC? And basically, Ray Dalio was kind of pointed in the path, and I know that this sounds funny, that, forget the rate hikes, the Fed may have to be back in a position for more quantitative easing or QE4. So it's become a pretty confusing issue. I mean, Some people may not think it is, but once the Fed put itself in this projectile pace to raise interest rates, and put itself backed itself into a corner, it couldn't have predicted what was going to happen with China over the next several months. And now that the markets have corrected like this, almost S&P, and I asked him this week, he did a great story, and I wrote several stories on 10% corrections in the S&P, and Wayne wrote one recently, and I believe that we fell short of a 10% correction in the S&P. But that said, here you've got one of the smarter people out there, questioning the Fed, should the Fed remain flexible? Well, I'm kind of torn here. I didn't think that they should have been raising rates anyways, but I guess the question is if they put themselves in a corner. Now, when I'm going to introduce Bob. Bob's going to talk about his spreadsheet. Now, I couldn't put the entire spreadsheet in because it's a proprietary spreadsheet. But the information that he's working off of, and Fair Value Trader will put that link in too, is the Fed link. You can get this information, and I'll tell you what. There have clearly been times that I know for a fact, and Bob knows for a fact, that when the Fed takes away or puts in money in the billions of dollars, and it usually ranges from $12.5 billion to $13.5 billion. When they move that money in and out of the market, the S&P moves up and down accordingly. Now I'm going to turn it over to Bob. Again, I think that what today's webinar is about, it's about sharing. It's about sharing different ideas and trying to pull those ideas together to have a roadmap, have an idea. That when you go into these markets, that you're not just shooting blind, because I'll tell you what, there have been hundreds and hundreds of times over the many years where I've seen the Stock Trader Almanac call almost literally every move of the entire year. So to discount it, I think is really, really wrong to do. But anyways, I'm going to turn it, let's see if we've got the next, okay, well, real quick. I'm going to put this slide up because this really, Bob can kind of go through this, but we all know that the Fed's got $4.5 trillion in bonds that it's already paid for. It's mostly long bonds and government securities and structured debt. Now, if you look at that video that FET put up of the CNBC with Ray Dalio, he actually talks about that. Now, where is this going to actually end up? Well, they will actually end up maturing, or they'll roll those bonds. But here's just a couple of facts that Bob wrote about that we should be thinking about as we go into looking at his spreadsheet. These are just some little things. And Bob, I'll have Bob come in. Now, Bob, I'm going to turn it over to you, and I want to thank you for coming in. I want to make sure that my mic is not up too high. But I want to make sure that Bob explains this. I know it, but this is really Bob's tool. He introduced it to me, so better that Bob come in, and I'm really appreciate him volunteering coming in and doing that. Bob, you here?
Yeah, I'm here, Danny. I don't know if my video's on, but let me just walk us through it. Can everybody hear me? Okay. There is video. All right, they can hear me. John, I don't know if you have the slide with my Excel file. Oh, maybe I'm the one supposed to move it? Okay, let's see. Okay, there we go. That looks good. All right. First, Danny, I want to thank you for inviting me. It's an honor to be presenting with such top-notch guys like Jeff. I want to first give us a unsolicited plug to you guys. First of all, for those of you who are listening that are not subscribers to MrTopStep, I got to tell you, I've been a member for maybe about a year and a half, And I couldn't say more positive things about the service that Danny offers. And what a guy, salt of the earth. The way he's so unselfish and generous, few people I've met like Danny. And I love his approach that he never stops thinking or looking for more tools to bring to his subscribers that will help us make money. Can't speak enough about it. Jeff, I've been a big fan of the Almanac, probably been a subscriber for about 7 years, and I echo Danny's thoughts that your calls have been spot on. If I was a long-term investor and I just did your sell in May and then buy in October, November, you know, I'd be a rich man. You do wonderful work, and now with Wayne, who Danny introduced to us on the radio show, and the way he works. One, I enjoy hearing him because he's got that southern drawl, and he asks the computers and he lets the data tell him where to go. And Wayne, I hope to continue following your stuff. So I'm going to go through my stuff and first tell you that I usually gather a lot of information, but I like to keep things simple. I view the market as a puzzle, and like Danny, I like to take all these tools and all these pieces of information and kind of have a game plan, and then ultimately let price tell me in which direction to go. I'm often early, but I like to ultimately let price tell me whether I should stick to my plan or not. You're going to see on the screen an Excel spreadsheet that I put together that I call it a liquidity pool. And it basically tracks the weekly changes in the Fed's balance sheet. As you may know, the Fed ended QE3 in October of 2014. And so on the website that, or the link that JC sent out, you can track this the Fed's balance sheet on a weekly basis. The report, and you can actually have the report emailed to you. It comes out at the end of, after the market closes every Thursday. And around 5 p.m. Eastern Standard Time, and it'll show the weekly changes in the Fed's balance sheet. When the Fed ended QE3, the balance sheet was approximately $4.2 trillion. The range of that balance sheet since October 2014 has ranged from 4.2 to about 4.238. So the Fed has been working with a wallet of about 36 billion. So this is how I simplify my reading of the Fed's wallet of 36 billion. When the Fed has used up most of its wallet, like it did just recently, if you look at the slide, I don't know if you could read it, in the week ending January 13th, 2016, the Fed had added 13 billion to its balance sheet, achieving a level of 4.238 trillion. Now, as we know, 2016 has started off rocky, to say the least. I believe that if the Fed had not added that 13 billion, we probably would have seen a deeper sell-off. And if you remember the second week in January, the market did go down, but it seemed to not fall as hard. The following week, this past week, the report ending on Wednesday, January 20th, the Fed withdrew close to $12 billion. And if you recall, from Thursday, January 14th close, the S&P dropped from peak to trough. So where was it on Thursday? It was 1934 at the high. And on Thursday or Wednesday, January 20th, we printed a low of 1812. So that's 122 points. And for me, a lot of it had to do not only with what was going on with oil, but you also had a liquidity crisis that was certainly aided by the Fed's withdrawing $12 billion in liquidity. So I guess in summary, what this tool shows me is the impact of liquidity on the market, and the Fed being the biggest provider of liquidity. When it's adding liquidity, the market's either rallying, or to the extent that there are economic forces that are putting downward pressure, it acts as a shock absorber. When the Fed is withdrawing money, it clearly has an adverse impact on the levels of the market. The market is generally facing downward pressure and selling off. Another observation that I'd like to share with you guys that I've noticed is that before every FOMC meeting, I noticed that the Fed has positioned itself to add liquidity to the market. So I believe that to the extent that it withdrew $12 billion from Thursday, January 14th through Wednesday, January 20th, it was to prepare itself for the upcoming meeting this coming Tuesday and Wednesday, 26th and 27th of January, so that the Fed can kind of smooth out the movements of the market and the excessive speculation that might take place. So right now the Fed's balance sheet is down to 4.226, so it's got some dry powder to intervene if it needs to. So I will close by saying that, in my estimation, some of the strength that you saw in the market towards the end of this week, and we'll see next week, will be driven. It would not surprise me to see the report that comes out on, I guess it would be week ending Wednesday the 27th, coming out on the 28th. It would not surprise me to see that the Fed added liquidity between the 21st of January and Wednesday, the date of the announcement of their meeting. And typically I notice that the market will remain strong for at least one more day. So I would not be surprised to see market be firm with an upward bias into Thursday of next week, possibly even Monday the following week, which would make it, I believe, February 1st. I do think that we might get a bit of a pullback between Friday's close and sometime Monday. But from Tuesday on, I expect the market to be firm into the meeting and possibly longer. I want to, Wayne and Jeff talked about their market views. I wanted to share with you something that I'm looking at in terms of a larger picture of where the market might be heading in 16 and 17. And I look at the 2014 low at 1820. I look at the new low at 1812. And I think if we don't take out 2020 on the upside, we may very well have a nice head and shoulder pattern that may take us down to 1500 on the S&P. So longer term, that's what I'm looking at in terms of the market. I think this if we are in a bear, and again, if we don't take out 2020 on the upside, we certainly will have a pattern that that suggests that we could trade in the 1500s within the next 2 years. Danny, I think I'm well. One last thing, shout out to my fellow friends at MrTopStep in the MIM and the IM Pro trading rooms. It's a pleasure to trade with you guys, and just the level of sharing that Danny inspires is incredibly helpful. So that's about it for me, Danny. You're very welcome. Danny, are you there?
Hey, Bob, thank you so much. Man, I really appreciate it. Another great example of, I appreciate it. And, you know, he's got his own proprietary spreadsheet, and obviously it's not something that we can hand out. We're not going to. We can't do that. But I think you got the basics of what he's been looking at, and I'm telling you that this is real stuff. Okay, so we don't want anybody to leave, and we see some people leaving, and I'm going to ask you not to leave. We've got some really cool stuff we're going to talk about. Yeah, we'll get.
Wayne, you got to shut your mic off.
All right, well, everybody's got to turn their mics off. Okay. All right. Thank you. So, anyways, before we did the Fed balance sheet, there was a reason that I put up that Ray Dalio stuff. Now, I'm going to ask Fair Value Trader to put up the Marko Kolanovic story. Now, Marko Kolanovic is on the complete opposite side of this. And I don't know how many of you guys know about Marko, but he's the guy that predicted the original flash crash, the August 24th flash crash, and his most recent report, he's been one of the most talked about. He's head of JP Morgan Global Derivatives and Quant Strategies. And he's really made the news a lot lately. And so here you got Ray Dalio talking about more quantitative easing. Then you have the head of one of the top analysts at JP Morgan coming back and, you know, talking about gloom and doom. And this is what I think has made this year very. Who are you supposed to believe? Who's out there coughing? So whoever's doing that, undo their volume. But anyways, I'm gonna flip to a couple slides here, and these are my slides. Obviously, you should recognize them. But at MrTopStep, as we move into the boot camp, everybody has their own things that they utilize, and what people will see in the boot camp is really that we have a collective of traders. And I use that term broadly because it is. It's not just at Chicago Stock or Tim Hefty from Top Notch Trading or WB. Everybody is in there and everybody is working together. But anyways, this is a chart setup that I asked Fair Value Trader to grab a couple days ago, where I was trying to catch a falling knife. And I caught the falling knife. I knew that we were at or near the low, and I'm always a little bit off, but I'm always off by a couple handles. But that said, what happens when you're off by a couple handles, it can offset your risk parameters, and it can blow the trade. So here, I buy the falling knife, I buy the futures, they pop back up, and I get out a part of them, and then the next thing that the futures do, they go flying back down to do the retest. Have you guys ever seen this before? Has anybody ever seen this act before? So once the S&Ps went my way, I did what we're all supposed to do, right? Move your stop up to break even. Well, somehow or another, they have this nailed down. And they really do. They have this completely nailed down. And I don't know how it works. In the forum, many of the traders in there call this the Riley retest. Now, I should know. I do, and I talk about this quite often, that you get out of, the pit bull says it's being half pregnant. You're never supposed to be half pregnant. You're either in the trade or you're out of the trade. Well, that's not the way it goes for us, because if we buy 10, and they go our way, we may get out of 5, and then we try to hold 5. Or you buy 10, you get out of 4, and you try to hold 6, right? And while you're trying to do that, you're trying to catch that falling knife. But when you do basically what the rules are telling you, is that once the futures go your way, you should bring your stop up to a break even. I will tell you that I believe that the algorithms have nailed this thing down. They know exactly once the futures make a low, that guys like you, guys like me, guys like everybody else out there are going to move their stops up, and that they've always got to go back down and do that retest. So when you're looking at this stuff, you got to be conscious of that retest. And Friday would be a great example of that, of the Friday too. I tried to short the S&P when it was going up. I sold 98 halves a couple times. They went up above 19 even. I get out. I scratch one time. I lose $1.50. But I knew that retest was coming. And people in my room will say that I'm a little crazy with the way I do this. But I would rather get in, get in, and get out real quick, and try to feel out that trade and catch it, than sit there and watch the thing go $3, $4, against me, get out, and then I'm out four handles on my position, and then I've got to make 4 handles back. So I try to get in and get out, and I've watched that from a couple of traders, and D-Car in our room actually does that really well. So I've kind of adapted to that. I don't get out quickly as he does, but I'm always willing to get back in. You got to be willing to get back in. But this is I don't know how. I believe that the guys that coded this stuff. Somebody asked me, how do the algorithms, or how does HFT trading know that the S&P is going to retrace the Globex lows? Obviously, it's been coded. How do the algorithms know about, or HFT know about, trailing stops? Obviously, somebody helped code this information in. They've got it down. Everything that we could think of, they've got it down. And while we've moved from the old style of trading and open outcry, we've gone into and those pitfalls. Now we've fallen into something completely different, where I was looking at an article last night. I can't find it. I lost it. But it said that over the last 2.5 weeks, algorithmic trading volume across all sectors has jumped by like 25%. So if program trading was only making up 60% prior to Christmas, it's up to 85%, 80%. This is unbelievable. And I think you see this in the daily swings of the S&P and everything else. It's not just, You know, people always think, oh, it's in the S&P. Well, we know it was born on the New York Stock Exchange, and when that got too crowded, they moved into our futures markets, and basically the CME opened the door for it. So we really can't do much about it. I know that there's some CFTCs talking about some new regulation, but I don't know how, again, I don't know how they're ever going to stop it. I just don't know. And I fully believe that they have messed up the markets completely, but that's the world we live in. Okay. You know, now look at it, this isn't a pat on my back. This is part of what I do. I'm not tooled or schooled in the art of drawing charts. I'm probably not your best person to say, hey, go read this research paper and evaluate it. But I believe that my eyes, you know, see certain things. And I tried to explain this on Periscope last week, that I worked for a trader called Rick Barnes. And after Rick got to know me, he knew I didn't know any charts. He wanted me to do a point and figure on the trading floor. I did that for like 10 minutes. But he used to call me. He used to ask me about what I was seeing and what I thought. I thought that was pretty cool. He was a very well-known trader. He was the first person I could ever see that had like 20 screens up on his wall. He was trading 10 markets at once. It was just amazing. And he was a successful trader. So back in the day, that was pretty cool. But he would call me up and he'd say, well, what are you seeing down there? I'd say, well, you know, Salmon Brothers just bid them up to 02, 03, and locals are off in 04s. And, you know, they went back and down. They traded that 26 level. You know, I think they go back down. They maybe trade 24, 26. And then all of a sudden, I swear to God, the bonds will go back down, trade 24, 26, and go back up. So what he would say to me is, because I didn't have the schooling or the education in order to read those charts, he thought that I had something to do with the boards and pattern recognition. And I believe that today. I believe that I've taken a little bit of street smarts, you know, kind of too long, too short type idea. And I like buying falling knives. I like to try to pick tops. And when I read these charts, it's not about drawing lines, but I do have moving averages, and I watch them cross over, and I follow volume. That's what I do. But anyways, when things really, really looked their worst the other morning, I went out to Fair Value Trader. This is exactly after the open. This is Eastern time. And I went out into our room, and I went out into Twitter and on StockTwits, and I asked where everybody thought the next 50 handles in the S&P would be. Now, part of this came from, again, watching TV and watching all the dummies on CNBC. Not one person bullish, no one talking crash exactly, but no one bullish. We got down to the big figure. I pointed this out, that I think psychologically people never talk about the big figure in the S&P. We couldn't hold 2100. I said this. We couldn't hold 20. Couldn't hold 19. Now we're at 18. Big figure right in front of it, coming into an important level. I said the next 50 handles would be up. The S&P rallied 65 handles in 3 hours. And I have to ask, do you think that this is normal price action? Excuse me. I don't think it was. But this is another example of the way the markets have been run over, and I just don't. I'm not quite sure what all the mechanics of it are, but I believe a lot of this stuff is geared toward electronic trading and things that we have no clue. We know nothing about, or nor will we ever. It's all behind the scene. It's all behind the curtain, and you know. And then the Dow was down over 500 points, and it rallied. I can't even remember. The Nasdaq was down 100 and ended up going higher on the day. I mean, this is the kind of stuff that, these are blow-up days. One other thing that I did know about this day is that I was looking for capitulation in the oil market, and I was looking for capitulation in the S&P, and it all set up correctly. Everybody was bearish, into the hole, and up they go. It's just little things that I do during the day, and I think that And again, you got Chicago stock, you got much better traders in the forum than me. And now, you know what, this is just, I don't know if you guys saw this. This is a Nadex chart, and I'm not even really prepared to talk about it. I was trying to talk to the guys that put the post up, but it's just another example of how quickly that the algorithms can move things higher, and literally no volume. And what I think has gone here is that, again, I think you have to go back a little bit. How does this get corrected? I don't think it can. I really don't think it can. And again, no one was saying this on August 24th, but I was the first one out on Twitter. I said it first. No one's saying this, but this is a flash crash. And then soon after that, everybody started talking about the August 24th flash crash. I know all about flash crashes. But anyways, just a quick example of that. I didn't have my notes in front of me. I'm sorry, but I think if you've seen this, you probably know a little bit about it. And then this is it so far this year. And I know it's it's a basic chart, but at the end of the day, look at this volatility that we've seen. And look at the net changes of this, and I just don't think that it's going to change. Oil may go up a little bit, oil may go down, but at the end of the day, I think that we're too early in the year to just say, hey, you know what, we're going higher. We're going to start going higher today. Now, we did see these lows, and we are going higher. And the Pitbull thinks that we could trade to 1920. That was a level that was put in here a little bit a while ago, and we did close well. But I just don't have this feeling that I think that you're supposed to go jumping in long into a rally like this. It's just not in me. Not based on how things have gone this year. So anyways, look, just a couple little slides, just a couple little food of thought. Marlon Cobb is going to come in here and talk about the MIM real quick. And then I'm going to come back real quick. I'll close it out and talk about the boot camp. And I really, really would appreciate it. I think you guys know that I put a lot of time and effort into this, and I think that the information that we've supplied here today with Jeff Hirsch, Wayne, Bob, it's really good stuff. And let's stick around for the close of this, because the boot camp is going to be an amazing boot camp, and I want to talk about it for 5 minutes. That's it. All right, Marlon, are you around?
Hello, hello, hello.
I think Marlon's around. Hey. Okay, Marlon, I'll let you take it away.
All right. Thank you, Danny. So I might want to put up that link to the boot camp. Is there anybody in here that doesn't know what the MIM is, or what we're even saying? It's MIM. It stands for the MrTopStep Imbalance Meter. And what we do is we look at both the open and the close of the basically the New York Stock Exchange right now, but we're working on some other ones. And we're trying to figure out, there's a mechanical process of opening and closing these markets, and it really doesn't have a lot to do with Fibonacci numbers or whatever. There's just an auction that's going to happen at the open, and the market's going to get open, and then there's a huge auction that's going to happen at the close. And if you trade stocks or options on stocks or futures on stocks, you should understand, if you trade around that time, so if you trade the last hour of the day or you trade the morning open, you better understand how the mechanics of that work. And if you want to do that, I'm not going to do that today. We'll do that all next week in boot camp. I'll be in there every day, and we'll go through it. And sometimes you have to hear it 2 or 3 times and to fully understand it. Am I loud enough? Am I too loud? Yes, I'm perfect. Okay, great. So what we got here? So we got our first slide here. This is the MIM in January, okay? And this is every day. And this is the snapshot that's taken at 3:45 every day, at 3:45 p.m. Eastern time. So all my times are going to be Eastern time. At 3:45 Eastern time, the market on close orders. And so there's something you need to know. What is the market on close order? All the market on close orders are frozen at 3:45. You cannot put a market on close order against an imbalance, okay? So if there's too many stocks going to be sold on the close, you could put a market on close order to buy, okay? And that helps them pair off the thing. The reason we have this, right, is so that they can close the markets and find liquidity and shake the trees and get everything for a nice orderly close. So these are snapshots every day in January, 3:45. What are these big institutions doing? The big money, putting big money in, taking big money out of the market. inflows and outflows. What are they doing every day? So far we've had, let's see, 14 trading days in January. 10 of those have been up. That means they had a positive net imbalance. 4 of them have been down, which is pretty incredible for a market that's pretty negatively open, right? And the aggregation of all of the imbalances so far is about 5.6 billion to the buy side. So mostly the money at the end of the day has been going into buying stocks. I mean, we shouldn't be surprised. There's new money coming into the market, and it's got to be put to work. Some of it's demanded by the rules of the mutual funds. So what I wanted to do is to pick the 3 strongest days. That was January 4th. That was the very first trading day. January 8th was a sell imbalance of 1.5 billion. And then January 15th was OPEX, and that was a buy of 1.8 billion. You just kind of look and see what happens to the ES contract in that last hour and what we saw. Okay, so let's just look at the first one. Okay, MIM in January 4th is the first trading day. We start our data up at about 2 p.m. Eastern time is when some of the early data comes in. And how we get our data is we aggregate it from the floor of the NYSE. So we're polling the floor brokers in the NYSE, asking them, what are you seeing for imbalances? Because they get early indications. It's not out on the feed yet. It won't be out on the feed till 3:45 p.m. Eastern time. But we're trying to kind of do, kind of like the New Hampshire political polls right now. So we're trying to build a picture of the imbalance. We start that at 2 o'clock. I personally don't use it till 3, although sometimes you do get early signal. So these slides are starting from 3 o'clock Eastern time. So here you see entry 1 at 3 o'clock on January 4th. Our MIM tells us we have 854 million to buy. That's a big number. Anything over 300 million, 500 million, I get pretty excited. Okay, and then the next number is the symbols. You see that it says 83%. That means of all the symbols that are on there, we probably had about 300 symbols that had imbalances. 83% of them were buy imbalances. Okay, so that's good. There's good bias. All the symbols are on the buy side. Of all the imbalanced dollars, that's total net sell and net buy imbalances, 83% of all the dollars in the orders are on the buy side. Like that. I like anything over 66. I like anything over 300. Prefer over 500. I'm excited. I'm going to take a entry into the market and see if I can play this close. Well, okay. Remember, futures follows cash. I'll answer your question. Keep your questions to the end, and then we'll go through them. Then what I like to do is because I'm trying to get the best entry before 3:45, right? 3:45 is when the whole market understands what the imbalance is. I have this little bit of advantage in time here because I think I've got a pretty accurate picture, right? So at 3:20, I look, is the MIM bigger? Well, it was $1 billion, 1.08 billion at 3:20. The dollars were 88%. Wow, even more biased on the buy side. The symbols, that's the pound sign, symbol percentage, was 87%. That's a lot of bias on the buy side. I like it. I'm lower than I was at 3, but that's okay. I'm going to add. So I add. 3:30, again, we'll look at it. 1.3 billion, like that. It's building. 87%, it's a little bit under, but the symbol percentage, look at that, up another percentage. I like it. I'm going to buy some more. 3 buys in, and then we wait for the reveal. It's called the reveal, the locked-in MOC numbers. So these are the actual numbers. Now we can aggregate off of a digital data feed, and we can see all of the stocks and what their imbalance was. Turns out the imbalance wasn't 1.3 billion. It was 2 billion, 83% of the dollars, 78% of the symbols on the buy side. Nice trade. Get out 355 per my rules. Made a nice 10-point trade. January 4th. January 8th. Let's look at a short going. Okay, we picked the top 3 out of the month that gave us the strongest signals. So, gotta remember to breathe. Entry 1 at 3 o'clock. The imbalance meter is telling us that we're 1.4 billion to the sell side, 85% of the symbols to the sell side, 75% of the symbols. 85% of the dollars to the sell side, 70% of the symbols to the sell side. Like it, I'm going to buy. 320, look, oh, it's even bigger, minus 1.6 billion, minus 86% of the symbol, 86% of the dollars, minus 74% of the simple sell side. It's a little bit lower, but I like the dollar side growth. I'm going to go in, I'm going to sell it. Sorry. Entry 3, 3:30 p.m., 1.7, still growing, 86% dollar. That's about the same, 75% symbols. That's a little bit bigger. I like it. I'm going to get in. Go short. wait for the reveal. Well, the actual number was minus 1.4 billion. So we overestimated the what the imbalance was going to be. It was minus 1.4 billion. We were 83%, 69%. But you know what? The market didn't like it. It continued to sold off all into the close, and for closes, we hold all the way down into the 4 o'clock close. So 1928 down to 1912. That was January 8th. Here is January 15th, OPEX. So OPEX gives you these huge imbalances, particularly in the morning time. And sometimes I think the morning imbalance on OPEX is a lot better trade than the afternoon one. So here we are, 894 million at 3 o'clock. We go in. Entry 2, it's up. I'm down. I'm in the red here. I'm down, but we're 873. That's bigger. $79 a little weaker. Symbol's a little weaker. I can't remember what I actually don't think I traded on an OPEX day. Entry 2 is 1.3 billion. Dollars 87. Symbol's 81. And then the reveal comes in at 345. That's when the numbers are all public. Everybody knows what the imbalance was. Turns out the imbalance was actually 2.3 billion. And then you see that the market kind of reacted. I mean, close. This slide goes way out to I don't know, like 6 o'clock or something, but it's that the 4 o'clock close was pretty flat. So it kind of went flat into OPEX. And that's what we see for the MIM. And so that's basically what we do. So we trade, publicly trade in the afternoon, starting around 2 o'clock. We look to see how it's built, get a little bit of bias. The room kind of discusses what they're going to do. And then also in the open too, it's 8:30 to 9:30 into the 9:30 open. So if you want to learn more about trading the close, a proprietary indicator, and just the mechanics of the close. I mean, even if you come in for the week, it's $29 or something like that to come in for the week of boot camp. If you come into the week, it's going to be an unbelievable seminar, week long, every day, to find out and to study a little bit how the close works. And then when you go off on your own, if you're not going to continue with the signal itself, you'll understand what some of these crazy moves are about at the end of the day. Okay, so I think that's my slides. Is there any questions now? Thank you, Fibonacci. Yeah, there are certain days that we won't trade, or at least I won't trade, and those are the day before the jobs number, because that's really highly leveraged date. I learned my lesson there and got burnt. The day before the Fed numbers, another bad day to use the MIM, because there were other things that are more important than what the closing mechanics are on those days.
All right. Well, thank you very much, Marlon. I know that you know, a lot of people have other things to do. How's the weather on your side? Are you getting a lot of snow there, Marlon?
Sorry, I got off. We are, all we are doing is supplying cold air to the south of us. We're actually not going to get anything here.
Okay, I got you. Well, thanks for coming in. And, you know, I want to nail as many people as we can before this, so I'm going to cut you off, and I'll talk to you a little bit later today. Thank you very much. Anyways, look at real quick, you guys. I think that I'm gonna, you know, I don't think that there's anything really prepared that I can say. I went out last night to a regular retail trader before I came on tonight, and I said, look at what's on traders' minds. You know, and I'll tell you what, I know what's on traders' mind, but there's always such an overload. And he a couple of things that we talked about. You know, are we making a short-term low? You know, a tradable bottom? I don't know. I mean, we're so early into the year. Next week, 50% of the companies in the S&P 500 report earnings. Apple, Facebook, Amazon, Microsoft, Boeing. We got a busy week, and somebody did put this in. I think, you know, there's a lot of speculation about central bank. You know, more QE. So we got a lot going on here. You know, and then what I was trying to do with those stories that Fair Value was traders putting in to show the difference between what these big pros are talking about. You know, here you got, you know, the guy from JP Morgan talking, you know, going down hard, and then you got Ray Dalio talking about, so where do you go with this? I don't really know. I don't really know. But at the end of the day, I'm going to make this very short and sweet. I believe that MrTopStep is dedicated to helping people of all levels learn about the markets. We continue to move forward on all fronts. The new website is garnering record traffic. We had a story go viral on it. We're posting on Yahoo Finance, on investing.com. You see our articles on Google. We're up all over the place now. And the reason for that is because we've got a lot of honest traders that are willing to come into our forum, talk about the markets, talk about levels, trade live. And what we did with this particular boot camp is we've extended it. I mean, I've expanded it. There were some complaints that there was some like downtime in the boot camp where, you know, the market would open. You know, we're not going to be pressing people into the first hour of trade with markets going like this. So, you know, 10 o'clock, you know, Chicago stock comes in and he does his hour and a half thing. And then he goes away, and then we wouldn't have something till the afternoon. This schedule is completely packed. And not only is the schedule completely packed, we've got some really, really cool announcements that we're going to be making. New partnerships, new technology that we're going to be putting up. And I'm going to be honest, I'm a trader by nature. And yeah, I like going on Periscope, and sure, I like doing a couple of YouTube stuff, but I'm going to be honest. Doing all this stuff doesn't help me trade. So at the end of the day, I am giving up something. I'm giving up my ability to sit there and trade like a lot of the good traders in our room. And what I want to explain is, and someone emailed me, and I'm going to jump off after this, is that I got an email from someone thanking me that, you know, I've helped him look at the markets in a different way, and he's been making money. And it came in today, and he said he's really looking forward to the boot camp. And I'll tell you what, a lot of you are experienced traders, and you don't really need anybody to tell you how to buy or sell. I understand that. You're from all over different parts of the world. You're from Spain. You're from England. You're from Dubai. You're from Saudi Arabia. You're from Ohio. You're from Colorado. You're from California, from Chicago. MrTopStep's got a following that goes around the world. And at the end of the day, this boot camp is an accumulation of all the hard work and effort that this company has done in order to get to where it is. And I believe that if you're a trader and there could be no better time with volatility spiking the way it is and everything moving so quickly that you wouldn't want to be interested in 5 days of intensive of what we do all day long at MrTopStep, how we make money, and all the honest traders in there that are all corresponding and talking. There's not one top dog in there. We're all top dogs. Everyone's a top dog. You're posting. If you want to talk to an individual trader, you just click on their name. You can talk to them, so it's not out in the open. So if you feel your questions are, you know, going to be ridiculed or something, nothing like that. Everybody's in it together, and I want to just put it out there that I think this is going to be one of the best boot camps that we've ever thrown, and I think it's going to be one of the biggest that we've ever thrown. And I'm hoping that you guys will join. And I want to reiterate one last thing. In honor of the current subscribers of the MrTopStep forum and the people that take the MIM, I cannot be on Twitter as much as I am on a normal day. I've already got a lot of complaints about people, me giving away all this stuff all the time. And during that week, I'm going to be kind of doing a shutdown. So I'm really, really encouraging you guys to join up and join MrTopStep. I'm going to leave it like that. I said it would be a couple-hour webinar. We're running a few minutes over, and I hope you guys have a great weekend. And before I go, I want to show you one last thing. My day is not over. My day is about to take this monster computer, this new monster computer, and convert it over to my charts so that I can run 6 screens at once. And I'm hoping that by the time you guys, I'm hoping that I can get this done quick, but I hope by the time that you guys sign up for this boot camp that I'll be able to show you these charts live. that I'll be able to do, you know, somebody asked me also today if I would do a live trading on Periscope. I have no problem doing live trading on Periscope. Not at all. But I'm not going to do that until after this boot camp. But again, I don't think that the boot camp is necessarily about me. It's about the collective as a whole, and learning and teaching and sharing. I'll leave it like that, traders. You have a very good weekend, and we'll see you later. I'm going to leave the document up. You know, we're also going to have this recorded, and there'll be a recording of this being sent out to everyone that signed up for the boot camp. Excuse me, for the webinar. Have a good weekend, everybody, and happy trading next week.